Hey, this is Chris from Mission Capital, and today's video is the third in a little mini series about adjusted EBITDA. Today, we're going to be building out the pro forma income statement, which is just an unnecessarily fancy term for what is the income statement going to look like in the future after we reflect all the adjustments down here that we did in the last video. So, effectively, we got our original amounts, we're going to link our adjustments to here, and then the pro forma is going to show the future. So let's just start with the definitional adjustments in the first EBITDA as defined schedule. We said we're going to add back 180 of interest expense. So I'm going to come to my interest line, go to my adjustments column and do equals negative, link to the 180 and hit enter. And so you can see that originally we had 180 of interest. We're going to adjust out the 180 here. And so on a pro forma or go forward basis, there wouldn't be an interest expense. And this would be if the capital structure of the business changed. This double check I have here is to see that if our pro forma net income will actually tie to our adjusted EBITDA or our diligence adjusted EBITDA down here. So let's keep going. The next one is the depreciation. Let's go find that. Here's my depreciation equals negative. I'm going to strip that adjustment out because it's non-cash. Enter. It was 90. I've adjusted that 90 out. Pro forma or go forward, it's a 0. Now let's look at the management ones because those are a little bit trickier. Management said that there's not going to be an R&D project of 200 and they hired a consultant that was only one time in nature. So let's go look for where we can strip these back out. And these won't always be super clear. This is a big part if you're a private equity analyst where to put these things, but thankfully this is fairly clear for this example. R&D. So we're going to go ahead and do that first one equals negative. Come down to that 200. I'll hit enter there. And so the original cost was 450, but management said, well, it's actually unrealistically high. We're going to take out 200 and the go forward is 250. So the next one was a consultant, I believe. So we can probably pull that out of professional fees. So let's do equals negative, come down to our consultant here, hit enter. And so of our professional fees, there was used to be 90, but it's going to be 40 going forward. The last two, the private equity firm adjustments, the transaction expenses for getting the deal done, and their management fee, which is an ongoing cost until they exit the business. Now, those two are right at the bottom here, so we can make these quick. We'll do equals negative, link to our adjustments down here, hit enter, and I can just press Control D to make this quick, or at least I thought so. There it is, Control D. So I've got these two expenses here in full. We're going to strip them out in full, and so on a pro forma basis or a normalized basis, those expenses wouldn't be there. And now we can see our check cell is equal to 0. Our illustrative net income, which really at the end of the day is what we're trying to do, establish a proxy or normalized free cash flow of the business, has now been reflected in the income statement here and what's people call pro forma. The reason this is so important is because if you're going to build a budget for this business, you're going to build it based on this column, not this column over here. And so this is why it's so important to strip out these expenses. And so that's it for this little EBITDA mini series on adjusted EBITDA. I hope you found it helpful. If you got any questions at all, please let me know. Thanks again. I'll see you in the next one.